Hello and welcome, subscribers, to the Saturday Summary for April 26, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. As always, I'm Jonathan Illig of Brokers Alliance, in for the biz. And I'm glad to be back at the summary after a respite for the long Easter weekend last week. Now, as always, we begin with what happened this week. As we go into the final full week, or really as we end the final full week of April 2014, the broad stock market indexes remain right about where they were when we began the year, continuing the flatness that has been the story of 2014 so far. Now, this week ended very badly for the investment markets as tensions between the US, NATO, and Russia continued to escalate over the situation in Ukraine, but we'll talk more a little bit about that in a moment. Looking at the broad market indexes, only the S&P has a gain for 2014, but that year-to-date gain is less than 1%. The Russell 2000 index is down almost 3.5%. The NASDAQ is down almost 2.5%, and the Dow Jones Industrial Average has yet to post a positive result for 2014. Now, looking at the summary, note that we have added three new statistics: the yield on the 10-year Treasury note, the price of gold is measured by what we call the afternoon London PM price fix, and the national average annual percentage yield, or APY, for the 5-year jumbo CD. That's as tracked by Bankrate.com. Now, our daily summaries included these really since the beginning, so we thought it made sense to go ahead and add them to the Saturday summary as well. Now, of note, thinking of those statistics, the yield on the 10-year T-note is down over 11% year to date. Now, this really matters to our subscribers because this is the benchmark interest rate that drives rates and benefits in the insurance solutions that we offer to our retired clients. However, this is not the lowest that the 10-year T has been in 2014. It was down over 14% year to date back on March 3rd. So we don't know what will happen. Thus far, we've seen some carriers reduce rates while others have slightly increased rates. So looking ahead, we'll see what next week brings us as we head into May. Now, what's behind these market doldrums? Well, for the most part, it seems to me that stocks are simply at the top of their price points, but yet not yet enough so as to cause large investors to begin to sell off in any large degree. Now, this past week was the first quarter earnings week, of course, when corporations report their revenue and their earnings. And for the most part, earnings were disappointing as inspectors, but still in line with expectations, albeit those were reduced expectations as usual. On that note, as the noted writer Buttonwood, who writes for The Economist, recently wrote, talking about these profits, he says, instead, chief executives are turning to that old device for boosting sluggish profits: takeovers. According to Thomson Reuters, the global value of mergers and acquisitions in the first quarter of 2014 was 36% higher than in the same period of 2013. Now, he goes on to say the right takeover can result in cost cuts through economics of scale, although in the long run, the academic evidence in favor of takeovers is mixed. He goes on to say a takeover boom is a classic signal of the final stages of a bull market, a sign that financial engineering has taken over from genuine business expansion. And that is hardly a surprise. The current market rally is already the 4th largest and the 5th longest running since 1928. So, no earnings juice there to spur additional gains, no juice for you. Now, at the same time, there has also been no economic or other developments that are really bad enough to cause the market to start the long-awaited correction, or possibly worse. Now, granted, the U.S. housing market has almost completely stalled. The most recent jobs report was not very good, and global growth continues to be tepid. But these factors seem to have become sort of the new normal, so absent some other type of catalyst, the levels of the market index seem to they're just staying right about the same. No juice either way, so to speak. Now, speaking of catalysts, the most obvious catalyst for downward momentum really reared its head on Friday, as tensions between the US, NATO, and Russia really escalated considerably over the situation in Ukraine. What happened was this week, Standard & Poor's downgraded Russia's credit rating to BBB-, which is their lowest level that is still considered an investment-grade rating. Russian officials on Friday threatened a whole host of retaliatory economic actions in response. There's an article about that on page 4. Now, on Friday, the impact of this tension resulted in the NASDAQ Composite Index to drop by 1.75%, the Russell 2000 to lose 1.8%, and the S&P to shed about 0.81%. Now, combining this sort of east-west economic sanction contest that looks like is going to start happening, again, due to the Ukrainian crisis, with the potential of a currency war. There's an article about this on page 5 that may be brewing amongst nations trying to devalue the currency in order to promote growth. Conditions really don't seem ripe to me for the markets to rise. More likely, in my view, they seem ripe for more of a downward catalyst. So if you are within 5 years of retirement or certainly already retired, please take heed. Do you have enough of your retirement savings in safety to guarantee at least the minimum amount of income you need to remain comfortable during retirement? Think about this. How would a significant market loss affect your retirement lifestyle? This is really food for thought. Again, I do retirement planning all week. We know how to do this. Now, on that note, our featured quote of the week. This is from John Brown of Euro Pacific Capital, who in an article on Thursday said, in the larger picture, much of the geopolitical balance of power that has been in place for much of the last 25 years will be tested on the banks of the Black Sea. Investors should take a few minutes from their daily technical chart analysis to consider these major developments. Absolutely so true. Well, anyway, that's all I have time for today. If you want to see something covered in the commentary or have comments, questions, whatever it might be, just contact me at the email address scrolling along the bottom of your video player, and we would love to hear from you. If you want a better quality of true support in your annuity and life practice, more than just, again, products, contact us here at Brokers Alliance. Well, that's your Saturday summary for April 26th of 2014. As always, thank you for joining us. We'll look forward to joining you again next Saturday.